It's 2026, and the biggest question for new investors is still, what can you really do with just $100? 4 years ago, a self-made millionaire put that exact amount to the test across 5 different investments. In this video, we're revealing the updated results, the lessons learned, and exactly how those $100 performed in today's market. 5 different investments, all accessible through a laptop. 4 years of real-world performance. We'll evaluate each one based on learning difficulty, passive income potential, tax advantages, risk level, and actual returns. Before we start, a quick disclaimer. This is not financial advice. Just one investor sharing personal experience. Always do your own research. Buying individual stocks means becoming a partial owner of a company. It's exciting because you're directly betting on businesses you believe in. Learning difficulty? High. Successful stock picking isn't luck. You need to understand financial statements, management quality, and competitive positioning. Every serious investor reads income statements, balance sheets, and cash flow reports before committing capital. One practical way to build this skill? Use demo accounts. Many investment platforms offer simulated trading. You can practice with fake money until your strategy proves itself. Passive income potential? Good. Stock investors have 2 ways to profit. First, price appreciation, selling shares for more than you paid. Second, dividends. Some companies share profits with shareholders regularly. You don't even need to sell. That's genuinely passive income. Tax advantages? Excellent. With the right account structure, like a stocks and shares ISA in the UK or a Roth IRA in the US, your gains can be completely tax sheltered. These accounts act like shields, protecting your profits from the taxman. Rules vary by country, so check what's available where you live. Risk level? High. During the dot-com bubble, some stocks made fortunes, others went to zero. If you concentrate your money in just a few companies and they fail, you can lose everything. So what happened to that $100 after 4 years? The investor used a rather unscientific method, a dartboard with 20 random stocks, blindfolded one throw. The dart landed on Samsung. Today, that $100 is worth $67.76. That includes dividends, 10 whole cents over 4 years, negative 32% return. But here's the thing, that same dart could have landed elsewhere. Apple would have turned that 100 into 170. Microsoft, 188. Nvidia, $908. The lesson? Stock picking requires strategy, not luck. Even with research, markets are unpredictable. But for those willing to learn, the potential is real. REITs sound complicated. They're actually simple. Imagine a friend collects $100 from 3,000 people. That's $300,000. They buy a rental property. Everyone who contributed gets a share of the rent. That's a REIT. You're investing in real estate without buying a whole building. No mortgage, no tenants, no broken toilets. Learning difficulty? Medium. Easier than buying property, but you still need to understand how REITs work. They own offices, shopping centers, apartments, hotels, and their income comes from rent. Passive income potential? Excellent. REITs are famous for dividends. Why? Because legally, they must distribute at least 90% of their taxable income to shareholders. If the properties are rented, you get paid. Most commercial leases are long-term, so income tends to be stable. Tax advantages? Excellent. In many countries, REITs qualify for tax-advantaged accounts. Put them in an ISA or Roth IRA, and those dividends stay in your pocket. Risk level? Medium. REITs spread risk across multiple properties, which is safer than owning one building alone, but they're not risk-free. If real estate prices fall or vacancies rise, both your dividends and your investment value can drop. 4-year results? The investor put $100 into a REIT. The share price dipped slightly to $98.59, but dividends added $11.93. Total value, $110.52, a 10.5% gain. Not spectacular, but steady income along the way. Digital money, no government control, no banks. Bitcoin and Ethereum run on blockchain technology, secure, transparent, and hard to counterfeit. Some people became millionaires. Bitcoin was the best performing asset of the last decade. Others lost everything. Cryptocurrency is not for the cautious. Learning difficulty? Medium. First, you need a wallet. Think of it as a digital piggy bank. Online wallets are convenient but need strong passwords. Hardware wallets are offline and more secure. Next, an exchange. Coinbase, Binance. These platforms make buying and selling easy, but choose carefully. Not all exchanges are reliable. Then there's tokenomics, understanding supply and demand. Bitcoin has a fixed supply. That's why people call it digital gold. Passive income potential? Medium. Crypto doesn't pay dividends, but there are other ways. Staking means locking up your coins to help run the network. In return, you earn rewards. Yield farming means lending your crypto for interest. Both can generate income. Both come with extra risk. If prices crash or platforms get hacked, your coins can disappear. The investor avoids these strategies, just holds coins in a hardware wallet. Tax advantages? Poor. Crypto taxes are messy. In many countries, even trading one cryptocurrency for another is a taxable event. Staking rewards count as income, and you can't hold crypto in ISAs or Roth IRAs. Risk level? Extremely high. Cryptocurrency is one of the most volatile assets on Earth. Prices can multiply 10 times in a year or drop 90%. The investor sticks to Bitcoin and Ethereum. Smaller coins? Far riskier. Security is also your responsibility. If someone hacks your wallet, there's no bank to call. 4-year results, $100 into Bitcoin, left alone. Today, 652.24, 552% return. That's extraordinary, but most cryptocurrencies fail. This is high risk, high reward territory, not for everyone. Gold has been trusted for thousands of years, a safe haven. When inflation rises or economies stumble, people turn to gold. Learning difficulty? Low. 2 main options. Physical gold, bars and coins. Many people buy jewelry as investment, but that usually means paying extra for craftsmanship. Coins are cleaner. Physical gold needs secure storage. Or you can buy gold ETFs, funds that track gold prices without you holding the metal. Click a button, done. Passive income potential? 0. Gold doesn't pay dividends. It just sits there. It preserves wealth, but it doesn't grow wealth. Tax advantages? Good. Some gold coins like UK Britannias are legal tender and maybe capital gains tax-free. Gold ETFs can go into ISAs, but rules vary. Check yours. Risk level? Medium. Gold is about as safe as investments get. It's held value for millennia, but there's an opportunity cost. While gold preserves, stocks and other assets can grow. 4-year results, $100 into a gold ETF. Today, 140.10. 40% return. Not exciting, but steady. Gold protects. Imagine owning tiny pieces of Apple, Microsoft, Amazon, and hundreds of other companies all at once. That's an index fund. It tracks a specific index, like the S&P 500. You're betting on the entire market, not individual companies. Learning difficulty? Low. No financial analysis required, no stock picking, just buy and hold. Most platforms make it simple. A few clicks and you're invested. Passive income potential? Medium. Index funds don't pay huge dividends, but the companies inside them do. Those dividends accumulate. Some funds focus on dividend-paying stocks specifically. Tax advantages? Excellent. In ISAs or Roth IRAs, index funds grow completely tax-free. Over decades, that makes a massive difference. Risk level? Low. Index funds are diversified across hundreds of companies and industries. One failure barely registers. Historically, the S&P 500 has averaged 8 to 10% annual returns. Short-term dong happens. Over 10, 20, 30 years, it's one of the most reliable ways to build wealth. 4-year results, $100 into an S&P 500 index fund. Today, $179.57, 79.5% return. This is why index funds are recommended for most investors. Simple, low cost, reliable. The investor's own portfolio is mostly index funds. Each investment serves a different purpose. Stocks offer growth potential with effort and risk. Index funds offer steady, long-term accumulation. REITs provide passive income. Gold protects against uncertainty. Cryptocurrency offers high-risk, high-reward speculation. The most important thing? Start. Even $100, given enough time and compound interest, can grow into real money. Time is your best friend in investing. The sooner you begin, the more time your money has to work. This isn't financial advice, just one investor's experience. Always do your own research. Past performance doesn't predict future results. But if you're ready to start, today's the day. Now in 2026, with the power of compounding and the right strategy, that same $100 could be on its way to becoming your first million. The time to start was yesterday. The next best time? Today.